So our first question is coming from Greg D via email. Greg says, "What's up, guys? My name's Greg, and I wanted to see what you thought about Picasso offering early investors an opportunity to invest for a limited time at $2.80 a share. Picasso claims to be the market leader in vacation home co-ownership with only 1% penetration in over a $1.3 trillion industry. Their website says you can see returns via IPO or acquisition. This is not by any means my forte, rather just something I came across on my timeline that I found interesting. Thanks, guys. Love the podcast." Robert, you want to kick this one off?
Yeah, I've been doing quite a bit of research on Picasso with us launching the Regulation A platform that's coming up. And I guess the way I would look at Picasso is make sure you understand what you're getting yourself into. Because yes, it is less expensive to invest in. Yes, you can buy these fractional shares, which is fantastic, but just understand one thing. It says that you're a co-owner, but this is a collaborative voting system with these properties. And that scares me a little bit in itself. But you also have to look at with these luxury rentals, you don't know what the HOA is going to do. You don't know what the local administration is going to do. Are the rules going to change? So I think it's a little high risk and a little low liquidity for me of how I like to invest in real estate. But if you want to have like this newfangled timeshare ownership in a property, then I think you could consider it, but I wouldn't start out there. I think Picasso is more for people that are already wealthy, looking to spread some money around because the fees are high as well. If you do some digging or you were to message the customer service team and ask them what are the total management fees that Picasso takes, I think you'll find they're a little egregious and expensive for my taste because I want my money to work hard for me. So for that reason, Picasso is not a good fit for me, and I don't think people should necessarily use it. There are a lot of other better ways to invest in real estate fractionally with less fees and more upside and more liquidity.
To specifically answer your question, Greg, as it relates to investing into the company Picasso themselves, you're totally right. I looked up, this offering. You can go to like picasso.com/invest or something about that. It's got a landing page that shows you, limited time, invest for only $2.80 a share by the end of May, and you get in with your $1,000 minimum investment and all these profits we have and things like that. In my humble opinion, if a company is offering shares to the public for a limited time, that just doesn't sound right to me. Don't get me wrong, it's cool that companies get to offer private equity essentially of their company to the public for a couple $1,000s. I think that's amazing. We should all have access to this specific asset class that is sort of these private markets. I'm a big believer in that. But to me, I don't think that I would be participating in this. In my humble opinion, a couple boxes need to get checked for me to want to invest into a privately held company. The first box is this company actually making a lot of money? And Picasso checks that box. They are claiming they made $100 million in gross profits during the first half of 2024. That's pretty cool. The second thing is, am I investing alongside of a lot of other really smart venture capitalists and private equity firms? Maybe Picasso checks that box. I'll have to look more, but I want to make sure I'm investing alongside of the world's smartest investors and capital allocators because I know I'm not that. I know at times that I miss things, but if I'm investing alongside of people who have had immense returns in their own portfolios over their tenure of investing, that gives me confidence. And the final thing here is like, Gregory, my friend, know that every dollar that you put into a private investment like a Picasso has opportunity cost. There is no liquidity, and you said it even in your email. Their website says you could see returns via IPO or acquisition. Who knows when an IPO is going to happen for this company, if ever, and who knows if an acquisition is ever going to happen. So what does that mean? It means that you need to be taking seriously that $2.80 per share and saying, should I instead put this in Berkshire Hathaway? Should I instead put this in Amazon or Google Google or Microsoft or Meta or Tesla because, again, you have complete liquidity on all publicly traded companies. You could put in your $2.80, have it go up or go down, and take it back out the next day on Public or any other online broker that you choose. So at the end of the day, I want to agree that like Robert laid out a lot of wonderful points around co-ownership of real estate investing through these types of platforms. There's a couple of them out there that are really popular, including this one. But then as it relates to investing into a privately held company, you all need to understand the importance of opportunity cost, investing alongside tenured and very successful investors, as well as understanding the business model, how they make money, path to profitability, path to IPO, things of that nature.
Yeah, the number one takeaway for me, and that was a great other half of this question, but for me is what are they charging me to use my money? And if they're making more money off of the fees to operate this platform, then that's a no for me because I want them in the trenches with me using my money, but I want to make sure that I'm making good profits from my money as well. And that's why that's the first thing I always check is what are the fees that they're charging to use my money and all the investor money? So make sure you look that up and understand it before you get into it.